what we want to do with my colleagues from the investment management team is reflect back on 2022. What has been
just the impact of the Russia-Ukraine conflict. So, and that has pushed its way through these inflation measures through much of the first half of the year.
Right. How have equity markets, Chris, played through in that environment? What has been some of the themes that you've been observing over the course of the year, and
sort of leads us into the mini budget in the UK, and just the impact. Although we think spike in energy prices is on the inflation basket, it literally feeds into everything. Even even the price of going to the swimming pool has gone up 25-50% because of the cost of heating a swimming pool, and that's all to do with higher energy prices.
And around the true potential portfolios, how have you and the team been positioning the portfolios as a result?
Have actually provided an opportunity, and our managers and we are taking advantage of those opportunities.
Hello and welcome to episode 148 of the Do More With Your Money show. Today we're recording it on Monday the 19th of December, and what we want to do with my colleagues from the investment management team is reflect back on 2022, what has been a very challenging and difficult year, both for asset markets but also in the broader context of some of those themes that you'll have heard us discuss on morning markets throughout the course of the year, be that inflation, interest rates, a war in Europe, COVID-19, which was a very dominant theme at the start of the year but has certainly faded back into the past at this point in time, except for China, and I'm sure we'll discuss that as well. But let's open it out and think about how some of those key themes have played out through the course of the year, in which we've seen negative returns from equity markets, negative returns from bond markets, challenging volatility from the perspective of all asset prices, including commodities, and how that has played through into different economies over the course of the year. So I'm joined by Raj, Kevin and Chris today, and we'll bring to the table some of those key points to really try and give you a view on our perspective of 2022. And I think firstly, Raj, probably coming to yourself, really the start of the year, very much with rising commodity prices, a situation exacerbated by the war in Ukraine. But maybe you can just give some context as to how commodity prices have evolved through 2022.
Yes, sure. I think commodity prices in general, as you mentioned, have been the one rare asset class which have performed through the year. Off lately, they have given some of those gains back, but casting our memories back to early part of this year, and then also in Q4 last year, we have seen a rise in commodity prices. Some of that was supply chain issues we were facing in across the board. Given the supply chain constraints we had seen in post-COVID crisis. So I think part of it was that related. And then we hit with Russia-Ukraine crisis. And then that's where the biggest jump in commodity prices, particularly energy and oil in particular, have been on particular rise there. If we just take focus on oil itself, if you focus on the US West Texas Intermediate, WTI, for example, but also from Brent oil as well, it's a similar story. We started the year at around $74.50 a year on 1st of January. At the peak of the crisis, we went all the way to $120. Then within 2 weeks, it got back to $90. So we saw extreme volatility over that period. Then we saw again another surge into the summer, early summer. It went back to around $118 across the board. And then since the early summer, we have been started giving back consistently those gains. And we bottomed, oil prices bottomed, WTI bottomed at around $71 on 9th of December. Today, it sits around $74.50. Precisely where we started the year as we speak this morning as well. So as we have seen a full round trip across the board, and it's important to realize that it's in the face of a strengthening dollar and weakening economy. So it's in that context you put it as a remarkable. Historically, if you look at the performance of commodities, and particularly oil, and most of them are priced in dollar. Stronger dollars typically is a headwind for commodities, and softening global growth is weakening is typically bad for commodities overall. So I think it's in that context it's been a very good year for commodities.
And maybe the other thing to bring into that is what's been happening in the gas market, because we've all heard and we've seen the challenges that's created for energy prices through the course of this year, the changes that governments have had to make in terms of policy response to that. And again, prices there were very elevated and remain very elevated today relative to history.
Yes, I think it's another example of it's probably a little bit more exaggerated because the Russian influence on global gas market is much bigger than the oil market per se. So I think, and particularly if you look at Europe, I think it's much bigger impact. If you look at European gas prices, which are Netherlands traded gas prices, we started the year at 107 euros per unit, and then it all peaked in the summer, early summer or late spring, around $340. And now they're back to $115 euros.
Yeah.
So I think it's similar patterns, and I think it's also there are parts of issues where Europe has also been able to source from other places like Middle East and US some of those storages.
And I think that's an important point when we think about the headlines that we often see. You would think that per megawatt hour we're still pricing at 300 euros, or it's just short of that in pound context, but we're not. We've seen significant disinflation in gas prices from that peak as we've transitioned through the latter months.
And the final bit to cover off is soft commodities, which is Ukraine is a particularly large exporter of soft commodities like wheat and other, corn and others. So I think this is another where we saw a big lurch up in wheat prices. For example, taking wheat prices $780 a bushel. We started the year. It went all the way to 1,300 in spring, and then we are today back below where we started at $750. So
I think that's one of the key things, isn't it? When we're talking about volatility, it's really the volatility that we've seen in those prices of commodities through this year that's been difficult for businesses to work with. It's been difficult for the consumer. It's been difficult for asset markets to try and price the direction of where prices have been going.
Yeah, so I think it's all in all. I think it's we have seen a big lurch up in commodity prices through the spring and summer, and they've probably come off quite markedly, and that's overall good for inflation as we move into 2023. And I'm sure we'll touch upon as we move along.
And I think that's maybe a point to bring in Kevin and think about just how that inflation backdrop has evolved. Clearly, we've heard of very significant price increases, but then significant price falls as well, which we've seen the headwind, but maybe we see the tailwind as we look forward.
Yeah, so I think if we go back to the start of the year, inflation in the US was actually very high. So inflation had been above 5% since May 2021. So there were building inflation pressures there going into the year. The UK was at 6% by February of this year, and then obviously the kicker for inflation has been the impact that the conflict in Russia and Ukraine has had on energy prices. Now, we think energy prices just at the petrol pumps, but obviously it's the gas prices, it's the impact those higher energy prices have on transport, on food production, and that feeds through into recreation and services. So it's actually a very broad inflation proponent, just the impact of the Russia-Ukraine conflict. So, and that has pushed its way through these inflation measures through much of the first half of the year. Now, US inflation peaked in the summer. And I think we're quite confident that there are building disinflationary pressures there, and we will see lower headline inflation prints certainly through the first half of next year. The UK looks also to have peaked. Our inflation basket's a bit different in the way that we choose to administer gas prices, obviously, so there'll be another small boost in January, but those effects sort of filter out, and from April next year, you'll really start to see the kicker of much lower inflation prints in the UK. So I think the worst is probably behind us in terms of the inflation impulse, and we're now going to see these much lower inflation prints through the first half of next year, definitely. And so far, not much impact on the labour market, and that definitely explains why we're getting the sort of language we are from the central banks, which is they acknowledge through their forecast that inflation will fall dramatically over the next couple of years and may even be near target in the UK within about 15 months. However, they do want to see some sort of weakness in the labour markets just to take the froth off those nominal wage awards.
I suppose that's been the thing that we've been able to observe in the data over the course of this year, that the inflationary pressures have kind of shifted a little bit from that which is in the durable side and the goods to more into a services inflation element.
I think in this morning's morning markets, that the comment that we tried to get across was really that we've now probably seen the last of the disruptive effects on goods prices from the COVID pandemic, and that impulse has largely run its course. Yeah. But now the baton was handed through the middle of the year into the services component, and I guess it's just how strong can labour markets remain through next year, and how much bargaining power do workers now have in a weakening economy.
And I suppose collectively we haven't really seen that translate into significant real wage rewards as yet. Even in the UK, it's front and centre of the news.
Nowhere
we don't
near.
see it.
Yep.
I would probably say we haven't seen it in the US and Europe as well. So
Yeah.
there isn't evidence of it really as yet, despite what we're seeing in some of that services data.
And this is why we have to, we should treat with caution any the somewhat hysterical comments about wage price spirals. I mean, it's very difficult you to have structural inflation when workers are getting wage awards which are about half of actual realised inflation. So the impact on real take-home pay is severe. So that should provide some, not so much a tailwind, but should really remove many of the headwinds that the consumers faced through this year.
Because it certainly has seemed, when we look at some of the commentary from the Bank of England, it certainly seems that they are more concerned about that, but it's like everything we do, looking for the evidence of it, we struggle to find evidence that is certainly the case, that there is building wage inflation, or there is real wage inflation.
Yeah, I mean, they're quite crudely, the bank's models would tell them that with inflation, with wage awards where they are now, it's impossible for them to get inflation back to target sustainably. Now, their forecasting ability is somewhat unreliable, but until they're proved otherwise, they will assume that they need to hold rates at current levels and probably higher to try and bring down and weaken the labour market.
It's interesting that you bring out that point about the challenge of forecasting and point forecasts. When we look back, just preparing for this, I was having a look back just to some of their data from November of last year, and just thinking about what was expected then. We were expecting inflation to peak, or the bank were, I should say, expecting inflation to peak at 4.3% in the fourth quarter of 2021, and that as we sit here today, the UK interest rate would be 1%.
Yeah.
And we're very different from that.
I think when you get global events such as the Russia-Ukraine conflict, it completely decimates the forecasts, and also the way that I guess the UK had the added inflation tailwind of the sterling effect. So obviously, as sterling weakened through the year, we were importing more of an inflation impulse from these commodities that are priced in dollars, as Raj was saying. So the forecasting ability of central banks, really beyond the forthcoming quarter, has been materially challenged over the last 12 months.
And it's a salient reminder to all of us to really think about the role that diversification plays, but also thinking about really trying to point forecast anything, be it in financial markets or be it in life in general, is fraught with difficulty.
Yeah, and I think it's why I'm surprised that markets this week, or last week, have put so much emphasis on these updated forecasts more than 1 year out, because it's a bit of a stretch to have too much faith that those forecasts will be right within a degree of error. I mean, there's still a lot going on in the economy with China reopening and these building disinflationary pressures, and it just maybe focusing on the next quarter or two is the best way to think about it.
And when we think about that, really bringing it into then asset markets in general, so the backdrop has been difficult from an inflationary impulse, from the responses that we've been seeing from central banks. How have equity markets, Chris, played through in that environment? What has been some of the themes that you've been observing over the course of the year, and let's bring some of those to life now.
Yeah, sure. It was quite interesting, actually. You started your introduction and there was one word in your introduction which was challenging. And that's actually a word that I think we've probably all used ourselves this year. And it has been a challenging year. So just to give you some numbers around that. So global equities in local currency are down around 17% year to date. If you look at that in sterling, they're down around 7%. And everything has been focused around elevated inflation and how aggressive central banks will be to bring down those inflation levels. I think it's quite interesting. For me, one thing that you have seen is quite a big reversal in equity style performance. So if we go back to really the previous decade, or certainly the previous 5 years, you've seen what we call growth as a style outperform value, and what you've seen here is a reversal of that. I was actually just looking at some share prices just when I was on the train this morning. So Meta, or Facebook to me and you, is down year to date from $336 to $119, so a drop of about 65%. Tesla's down from about $352 to $150, so a drop of about 57%. And something that some people use as a barometer for growth, which is Scottish Mortgage Trust, is down around 45% year to date. Now, what's quite interesting is if then you look at the value side of things, particularly if you look at things such as, say, the energy sector, that's actually up 44% year to date. So you've seen massive divergence between sector, between region, between individual stock performance, and being on the right side of that can either be very, very beneficial, or if you're on the wrong side of it, then
what do you put that down to for our viewers and our listeners? Maybe bring out what is it that's been driving that differential in performance, particularly as we heard from Raj there on the oil price. It's basically unchanged over the course of the year, but I think your energy sector was up around 40%.
Yeah, absolutely.
So what is it that's driving that?
Yeah, sure. So what you've seen is the oil price, although over the year hasn't really changed, actually it's been quite elevated for a lot of this year. So particularly if you look in the second quarter and the majority of the third quarter this year, you got the oil price that is over $100 per barrel. So that's been very beneficial to those energy companies overall. I think maybe looking at the other side of it, which is, what's really hurt the growth style companies. Obviously, we've moved from being in a very benign interest rate environment to now in a rising interest rate environment overall, and that is painful for that type of company overall.
I think just one word on energy companies particularly. I think it's important that if you look at the earnings revision for next year as well, so most of the earnings revision we have seen in other sectors, but energy sectors typically hasn't seen the weight of earnings revision. And one peculiar factor about energy companies is that they typically hedge out 9 to 18 months out their book. So if they have hedged out their book in the middle of August or middle of summer, they would have hedged out their books and EPS or earnings for next year through to 2023. So I think some of that is also playing a factor into why this round trip hasn't completely been baked into because of the hedging dynamics.
I think a very strong performance from the sector, despite all of that.
Yeah, absolutely.
Bedding in potentially different prices. And it kind of struck me, Chris, when you were saying there about some of those large cap growth names that we've discussed, we've seen perform very strongly. The amount of value that's been destroyed there is quite significant over the course of the year.
Absolutely. I mean, you've seen very significant moves in share prices there. You've seen in some ways investor repositioning, with a lot of investors moving away from that type of stock, but having been positioned in that type of stock for a very long time. So for me, I think this year is almost characterized by a regime change. And actually quite a significant move from what we've seen in the past. Yeah.
And how would you sort of characterise it at a regional level? We've talked at a sort of a style level in a broad market sense. Clearly, some of those moves that you've seen, there must have been a more negative impact in the US potentially, or not?
Yeah, sure. So if we look at the kind of best and worst performers from a regional perspective, it's very, very rare that I say this, but the UK is the best performer, but we need to be a little bit careful here because it's the FTSE 100, so that's the largest 100 companies, and there's various different reasons for that, but I suppose really the main one is around currency. And one thing we haven't talked about, I'm sure we'll cover this a little bit later on, is just the volatility that you've seen in the dollar, the volatility that you've seen in sterling as well, but particularly the dollar strength that we've seen. And that's beneficial for those larger companies that are selling their products overseas, so potentially selling to dollar buyers, therefore their products become cheaper overall. Yeah. So just giving you some figures, FTSE 100 is actually up year to date. It's up 4%. But if you then look at the FTSE 250, so that's the next 250 companies by size after the 100, that's actually down 17%. So it just shows the difference there. I think if we just look at what's happened on the more negative side, probably the one I'd bring up would be emerging markets. We've got to be a bit careful because emerging markets are incredibly wide-ranging. You've got some that have done very well. Yeah. So say, for example, Brazil, Mexico, they're actually both in positive territory year to date. But then if you look at what's happened in China, particularly in respect of the zero COVID policy, and obviously the last month you've seen quite a bit of change there. But if you look over the year, you can see that that's been a challenge.
And I suppose the other thing around that, it's strange for us to maybe say that Europe has actually outperformed the US in the context of everything we've started the conversation around, the inflation backdrop, a war in Europe. European equities have outperformed their US counterparts, and indeed that's something that we couldn't have said for quite a number of years as well.
I think that's a good point. I mean, what you've seen is, for good reason, a lot of people have been quite negative on Europe, particularly when you think around the kind of energy price backdrop, particularly when you think about, obviously, the conflict in Ukraine. And what you've seen is actually things haven't been as bad in respect of the energy price backdrop as maybe people thought. So certainly what we've been seeing with a lot of our managers is a significant increase towards Europe overall over the last few months.
Okay, and I suppose that's one asset class we've looked at. We think about multi-asset, we think about the role of sovereign bonds and the role of credit within that. Kevin, just from your perspective, maybe it's worth bringing some of that together in terms of central bank policy changes that you're alluding to, how that's played through into the performance and the difficult performance that we've certainly seen from sovereign bonds in 2022.
Well, as you said at the start, we've had a negative total return from bonds this year, and that's a very rare event. I guess the primary reason for that was bond yields were very, very low this time last year because of zero interest rates and QE from most of the major central banks. What the main shock to bond prices this year, so that's caused yields on bonds to rise, has been the willingness of central banks to just go with it and say we are going to hike aggressively, and that's why we've had, mainly in the US, the quickest tightening cycle in about 40 years. So that has led to much higher yields on short-dated bonds. Those bonds are the most reflective of the policy rate of the central bank. And also we've had much higher yields on longer maturity bonds, so those bonds which are more reflective of the combination of inflation and growth. And that's given us valuations today in bonds which we haven't seen, mainly, for instance, in the UK, we haven't seen for 15 years, since before the GFC. But that will have an impact. This is higher borrowing costs for the government. This is going to be higher mortgage rates for homeowners, and if we rely on the bank's forecast to some extent, those higher policy rates will be with us for a couple of years. And the kicker for everywhere outside of the US has been the FX move. The dollar has had a great year. Most major currencies have depreciated versus the dollar, as the tightening cycle led by the US has led to dollar appreciation. And that, unfortunately, has, if we take the UK as an example, has probably exacerbated the inflation impulse, mainly through the energy channel. And that's why we've had these higher inflation prints, and so we've had these higher expectations for.
And I think that context of interest rate changes is really quite important. We use morning markets as a way to discuss the change that happens at each of the meetings, but at times you forget maybe the context that we've seen effectively 425 basis points of tightening in the US in 12 months.
Yes.
As you say, we have to go back to the early 80s to see something at all comparable to that.
And it's also, and what matters more for markets is what's built into the expectations channel. So we've had for around 425 of actual tightening, but the market's got got us going through to 5%. So another 75 is in the price, and that's what's feeding into bond yields. And you said, Jeff, that alluded to how quickly things can move, and that sort of leads us into the mini budget in the UK, and just the impact. Although we think most of that has been unwound to the proposed tax and spend initiatives, it hasn't from the bond market, and it's difficult to characterise for our viewers just the impact that has had on pricing from the Bank of England, for instance. It was quite modest. If we go back to the middle of the summer, expectations for the Bank of England policy rate were around about 2.5% next year. Year ahead, we get to 2.5%. And then once it became clear that Liz Truss was going to be the next Prime Minister, those expectations really started to pick up. But of course, the moment that mini budget was proposed, then we went from a policy rate of somewhere just above 3 in terms of expectations to expecting something close to 5 in the 12 months ahead. And despite most of this being rolled back, despite the peak in inflation being behind us, and despite some fairly pessimistic forecasts for growth from the Bank of England, the Bank of England have communicated that they do intend to hike in line with what the market expects. And that means, that's going to give us possibly a bank rate that we haven't seen since 2007. And that's, and the economy we have today is very different from the economy we had just before the global financial crisis.
And certainly, as you say, the other area where we did see volatility around the mini budget was just very much longer dated gilts, quite dramatic moves. I remember sitting there looking at the screen upstairs thinking, is there something wrong with it, given the scale of the move that we saw on the Thursday and the Friday, and then into the beginning of the following week?
I think the takeaway from that is just the power politicians have on markets, but also the power capital markets themselves have to just stop everything. So we were looking at one of the largest weeks of volatility in the gilt market, where gilt longer dated yields on gilts were moving about 100 basis points. So in price terms, that means the prices on these longer dated bonds were moving 20 to 25%, sometimes in a day. And the government wouldn't be able to fund itself in that type of market environment. We were seeing and hearing about mortgage brokers pulling products from the shelves. It was incredibly disruptive for both the retail market, for people who get consumer loans and get mortgages, but also for capital markets, where the bond market was effectively shut for over a week. And of course, we had the Bank of England having to step in.
And as you say there, I suppose it's an interesting point to reflect on, that probably this year, 2022, out of many of the recent years, we've been much more influenced by geopolitics and the impact that can have on asset markets in general. It's been very, very evident.
I mean, absolutely. I mean, I think it's very difficult to understand how pervasive the spike in energy prices is on the inflation basket. It literally feeds into everything. Even the price of going to the swimming pool has gone up 25-50% because of the cost of heating a swimming pool, and that's all to do with higher energy prices. It just really feeds in through the entirety of the inflation basket.
And one of the other things then I wanted to move on to then is thinking about how our managers have reacted to that. What have they been doing in response to this evolving and volatile environment in the background? We get great insight from them. They're crucial in terms of the management of our clients' assets. But what have they been doing, and how have their views evolved over the course of this year?
I think that this is an important point. I think it's a privileged position in Reset, in that true potential across the portfolios. We have got the diversification across, not only by the style, by the way, by the size of the investment teams, and then the views we get and the interaction we get from them. So it's been, as we've been discussing, it has been a difficult year for all market participants. So our managers are not immune to those seismic shifts we have seen in the market. So we had a few of the managers were cautiously positioned in the back end of last year. So they entered 2022 on a fairly cautious footing. When I say cautious footing, is they've been reducing their equity beta overall, and they've also been raising cash, not committing too much capital into bond market because of the interest rate rise fear. So I think that's one part. But there we had other set of managers who have been more balancedly positions. They believed in investing for longer term, and so we saw some of the managers being invested fully in that context. But then as the year progressed, we started seeing many of the managers started to realize that we are probably in a different market backdrop, started shifting the position towards the sectors which Chris alluded to as a value sectors overall. So we started seeing many of the managers shifting towards their growth biased portfolios, towards a more value biased portfolios. We see some of the managers buying commodities through trend products, which have done exceptionally well. That has been beneficial for the portfolios. We saw some of the managers shifting away from growth style equities to value. We have managers like Schroeder, which have been consistently a value biased managers who have done exceptionally well.
I think that's a very important point that you've just alluded to there. It's the consistency of the focus of those managers. They're there and they're part of the True Potential portfolio solution because of what they bring from an investment philosophy and an implementation perspective. And it is that diversification of view and diversification of approach that's fundamental. Going back to sort of my earlier points around, it's very difficult to point forecast. We wouldn't want them all to be positioned in the same way.
I think this is precisely the point. As a portfolio manager, me, Chris, and George, is it important to have that rooster of managers who have different views but have been identified as a skilled manager in their particular shift they want to. And we want that diversification, and that is most valuable, and that has come to fruition. If you look at the 60-40 portfolio, for example, versus what we and our managers have delivered, I think it's a good outcome, and its outcome with diversification is come to fruition. And it's not that they have been stagnant. I think it's important as the year have evolved, they have shifted the manager position.
And it's been a natural evolution because of that volatility. The volatility has created opportunity. If anything, one could argue that over the past 10 years of volatility has come down. It's been very difficult for some types of managers to demonstrate outperformance. It's been more evident this year in certain asset classes.
I think this is precisely as Kevin mentioned, the valuation aspect. Many of the managers, if you would have talked to bond market, was pretty much fully valued, not uninvestable, no manner of juice. And we started seeing the shift in the middle of this year. Managers started speaking about the valuations are becoming attractive, still a bit cautious on committing, fully committing up it, but started gradually drifting into those bonds which have become attractive. And we started seeing that being played out throughout the years. So duration, not outright long, but had been overall bond exposure have gone up.
It certainly has, and maybe that's a point, Kevin, to bring yourself in, just in terms of how valuations have evolved over the course of the year. We've certainly seen, in an equity sense, quite significant deratings in certain markets, and as Raj has been mentioning there, in sovereign bonds and in credit, in terms of how spreads have evolved.
Yeah, so just on equities, we've gone from very lofty multiples at the end of last year. Markets were clearly too bullish on the outlook for interest rates and how that would feed through into valuations. Valuations have come down considerably, but if we were to put it into perspective, US valuations are roughly around the long run average. So we've had a substantial fall in price, but because of the market belief in the stickier component of earnings, the multiples from the US are probably around the long run average. Certainly places like the UK and Japan still look attractive, but we need to have the broader conversations about whether it's perhaps just the earnings component of that, because of the energy influence. For instance, in the UK, is perhaps making some parts of the UK market look better value than they perhaps are. Emerging markets looks interesting, given multiples that have derated. They're below average, not too far below average, but it's worth just thinking about, given they don't have the same inflation pressures in parts, particularly in parts of Asian EM, and with the definite peak in LATAM EM, there may be an investing opportunity there looking forward. But the real valuation change has been bonds. If we go back to the end of the summer 2020, we had the most expensive bond market since Victorian times. Now we've probably got the cheapest bond market in 15 years, particularly in the UK. And the reasons for that we've discussed. The Trust mini budget, the Bank of England, but the opportunities in fixed income now are nothing we've seen before here at True Potential, something we haven't had for 15 or 20 years. And I think you can you can take component parts of the bond market to build a nice diversified portfolio. Give you an example. Yields on shorter dated UK credit are very attractive. So these are investment grade, good quality companies, banks such as Barclays, companies such as Pfizer or AstraZeneca, who issue in sterling, and yields there, you can get 5 to 6% on a bond which is investment grade. And if you look at real yields, so these are bonds which are adjusted for inflation expectations. US inflation protected bonds are at 15-year high in valuations, and you get the inflation protection there should inflation not quite get back to target in the US over the next 3 to 5 years. So a substantial revision to valuations of fixed income, which really explains why we've had a total return loss. But now we should now expect them to be a far larger weight in diversified portfolios, component parts of fixed income, just given the potential returns you get.
I think that's the important point, is how the returns have changed. We often think about the valuation or the negative that we've seen from the price performance. Now, it is a negative and it is real, but it certainly creates opportunity as well as we look forward. And certain areas that you've been highlighting there, Kevin, from a valuation perspective, Raj, you've discussed how our managers themselves have made changes to capture some of that. Chris, just bringing it to conclusion then around the true potential portfolios, how have you and the team been positioning the portfolios as a result of everything that we've been discussing, and allowing the TP solution to manage its way through this difficult environment for our clients?
Yeah, so basically we came into the year and we were fairly conservatively positioned if we look at the asset allocation compared to history. So you're looking at around about 56% in equity overall, cash levels at around about 5%, fixed income around about 28%, and alternatives probably around about 9%. Yeah. And then as we went through the year, we positioned even more conservatively. So in January, we took equity weightings down further, and we added to cash. Alternatives has been a really good asset class for us. Raj mentioned trend products. I think the AQR trend product that is held by TPP is up around about 30% year to date. So that's been a really beneficial asset class for us. So we spent most of the year very conservatively positioned, which I'm pleased to say has been right. But I think maybe thinking around where we are now and what changes have been made over the last couple of months, we've actually seen our managers and ourselves start to spend some of that cash. So particularly in the fixed income market, as per Kevin's discussion before, but also within equity markets as well. So what you're seeing is the very big moves that we've seen in asset classes so far this year have actually provided an opportunity, and our managers and we are taking advantage of those opportunities.
And I think the other thing to bring out as well is that, yes, they've discussed the backdrop, but the portfolio solutions evolved through this year as well, in terms of new partners coming into the solution and them bringing and adding to the opportunity for the future.
Absolutely. We're delighted that we had 2 new partners, which were Pictet and Waverton. So that was launched in February, and we also launched a new fund with UBS as well. So for us, what we would never want to do is kind of sit on our laurels. What we want to do is to always evolve the true potential portfolio proposition, and that can be evolving the allocations, it can be our managers and the evolution of what they're doing, but it can actually be bringing on new partners as well. So we're constantly reviewing the managers that we work with, looking to understand, is there someone else out there that is better, that could bring something extra to the portfolios overall? And I genuinely believe that we've done that in February.
Okay, thank you. And thank you to you, our listeners and viewers as well. It's been a difficult year, but thanks to Raj, Kevin and Chris for giving us a whistle-stop tour of some of the key things from an investment perspective as to what has been front and centre of our discussions. And thank you to our subscribers on the YouTube channel. This year we've seen tremendous growth, and we've moved above 10,000 subscribers. So please do hit the subscribe button if you haven't. You'll join us again for an outlook piece for 2023 when we get into January of next year. Many thanks. If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.